You know, Eric, on this show, time and time again, founders talk about the importance of hiring great employees.
And they always say it's so hard and so important early on to hire the right person.
It makes a lot of sense that it's difficult because most founders don't have experience doing high-level searches or hiring top-level talent.
And they're also limited to their local talent pool a lot of the times.
That's why a lot of founders choose to work with SPMB, one of the fastest growing executive search firms in the country. For over 40 years, SPMB has specialized in recruiting upper management and board members to early stage VC-funded startups and larger growth stage companies too.
They bring the knowledge of a large global firm and combine it with the personalized service and attention of a boutique.
They have a dedicated team focusing on the Mountain West and Midwest emerging tech markets, so no matter where you are in the country, if you're trying to hire top-level talent, SPMB can help you out.
If that sounds like you can go to upside.fm/SPMB to learn how they are closing hundreds of C-level searches annually.
We're at the earliest innings of these companies. There's not a lot to evaluate relative to later stage companies. So I've always had this philosophy that we need to ensure we capture outliers in this power law dynamic that is early stage venture capital by investing in a lot of companies.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside. Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my longtime co-host, Mr. Unicorn Plushie himself, Eric Hornung.
3 years, Jay. 3 years, 3 hellos, and we're doing it. I have a unicorn plushie. Maybe we'll have to get 3 of them, for one for each year.
3 years, 159 weeks. No, there's 52 weeks in a year, 156 weeks.
Big math guy.
In 200 episodes of Upside.
Isn't that crazy? 200.
That's a lot.
Think about how much time you and I have spent talking to each other on the mics.
Yeah, it's more than I ever thought I would talk to you or wanted to talk to you.
Here's the crazy thing. None of it, 0 of it, was possible without the people who took a risk on us early on in this process when we just were an idea and probably not even the best idea.
Remember how hard it was in the beginning to even just get guests to come on the show? It felt like such a reach to reach out to anybody and ask them if they would come on this thing that doesn't really exist, that doesn't really have listeners at the time, and talk with us.
For an hour and a half.
At the time, yes, it was. No, the whole episode was an hour and a half. We've never talked for more than an hour in an interview.
That's true.
Still a lot.
Actually, that's not true. Vlipsy, we talked for like an hour and 25 minutes with him.
Well, that was just a great conversation.
True. So one thing that changed for us, one thing that was a big catalyst for us early on in making it easier to get guests on the show was we found an advocate, Jay, early on.
We had a secret weapon.
He was out there. He was giving out unicorn plushies to me, not to you, of course. And he was advocating for us to his portfolio of founders. We've had 10 of them on to date, Jay. 10
founders from this portfolio. And while we are celebrating our 200th episode here, we also want to hail to the victor, Victor Gutwein, the founder and managing partner of M25, which was really picking up steam around the time that we were picking up the mics and has since really built quite a name for themselves. But all along the way, Victor has been an incredible advocate for us, introducing us to companies. Let me name off our 10 podcos that are within the M25 portfolio. We have Pear, Loop, Local Crate, Somersault, Upsy, Super Dispatch, RapChat, Open Doors, ScriptDrop, and Chris Bergman's new company. That's a cool 10 portfolio companies. And Eric, those 10 alone, pretty great portfolio, if I say so myself.
Yeah, it's almost, probably says something about Victor's portfolio.
That's what I'm saying.
Yeah, our portfolio, Victor's portfolio, there's definitely some overlap there. And we are stoked to, although we did not invest in any of those companies, be media co-investors with him.
Victor started M25 in 2015 in Chicago, Illinois. He's a Kauffman Fellow, Class 22, former leader of Hyde Park Angels. And Eric, little known fact, has an Uber rating of 4.89 out of 5.
That's pretty good. I think I'm stuck in the 4.7s because I had some friends who were terrible in college. And I think I've kind of baked in that score. I'm not getting over it.
Uber ratings are often a reflection of your friend's behavior more than your own behavior, unfortunately.
Yeah, I think that's true. So it seems like Victor has great friends.
And you want to have great friends. If you're trying to live this one life, you have to live the best way that you can.
That's true. Friends are a reflection of happiness in the long run. And if you, dear listener, have some great friends or you want great friends, reach out to our friends at Ethos Wealth Management. You can learn more at upside.fm/ethos.
M25 is an early stage venture firm based in Chicago, as I said, investing solely in tech startups headquartered in the Midwest. And they do have a very strong stance on what the Midwest is, Eric. One of the few firms that will take a hard stance on what is and is not the Midwest. Since launching...
What's the most controversial opinion in there?
To Wisconsin? Nebraska?
I think those are all very Midwest. How about Louisville? I feel like Louisville is
Louisville's not on their Midwest map.
But a lot of people feel like it's Midwest.
It does feel Midwest. Yeah, Midwest is just an interesting title. Why is Ohio Midwest? We're more like Mideast. But there's no such thing as a Mideast.
No.
Since launching in 2015, M25 has become the most active investor in the region, while being led by two of the youngest fund managers in the industry, in Victor and his partner, Mike.
I still can't believe 3 years, dude.
3 years, 200 episodes. One hell of a podfolio that we should really do some analysis on.
Yeah, that we seem to be very geared at you.
It's a pointed we.
Me.
More of a royal we than a true we. I'm talking about Mr. Math Guy, Mr. Plush Unicorn himself, which we didn't even talk about. Very salty about this plush unicorn that you have that I don't have.
Victor, we got to get Jay a plush unicorn. Or don't. Actually, don't. That would be better.
The gift of the M25 portfolio companies, Eric as an honorary member, and here I am, unicornless.
Unicornless.
Unless you look at our podfolio, in which case soon, I'm sure we will have a unicorn in that podfolio. But without further ado, let's talk with our good friend and advocate, Victor Gutwein. We'll get to that interview right after this.
I hate that we've demonized scheduling links, Jay.
Scheduling links are actually one of my favorite things. I love the ease of someone saying, here's when you can book a time with me. And then I can choose when it's best for me too.
Whenever I get an outreach and someone says, what time looks good for you? I ask them, hey, do you have a scheduling tool? And you know what scheduling tool I wish they had?
Which one is that?
It's a new scheduling tool called SavvyCal. SavvyCal makes it easy for both parties to find the best time to meet.
SavvyCal makes the scheduling process even more savvy than any other scheduling tool that I've seen, and I mean that. It makes it so easy to personalize your link. You can say, hey, this is a meeting time for Jay and Eric, and it just looks so professional, so sophisticated.
So much so that we're going to be using it for Upside going forward, and maybe even rolling it out to the Upside network.
You can use SavvyCal as well. You can sign up for a free account at savvycal.com/upside. That's SavvyCal.com/upside. And when you're ready to upgrade to a paid plan, you can use the promo code UPSIDE for a free month.
Thanks for having me, guys. I am from Indiana originally, born in a small town called Rensselaer, and then we moved to West Lafayette. From generational farmers to entrepreneurial businessmen. My first startup was a vending machine business where I had those small 25-cent bubblegum machines, and I put them around town when I was in middle school to generate money while I was at swim practice or at school. I just wanted to earn a living, really save money for college at that young age, and went and did some other businesses like a landscaping company in college or in high school. And then in college, I started a scooter company, which was to get around campus faster. I brought a scooter and then I started selling them around to people. These were kick scooters, like adult-sized kick scooters. It was ahead of the time for when people were actually thinking that scooters are cool. I remember seeing the boosted board when Boosty Board came out, I said, hey, we could put that on a scooter, but I was not nearly as capable or as skilled. And me and my co-founder really just had it as almost like a hobby in college while we were, getting other school done. And, I really enjoyed that experience though. It got me kind of rubbing shoulders with people that were doing more tech related startups like apps. And I wanted to, learn more about that. One of the things we did was we were on the founding board of a student-run venture fund at the University of Chicago, where they gave us like $100,000 or $200,000 to start off with, and we were making very small, like $1,000 dorm room investments, basically, but modeled after a venture capital fund. And I thought this was very interesting. I did not know that venture capital was even a career option, but this was my first exposure to it, and I thought, hey, I got to try this. And so after that, I started to think about venture capital, how to get into it. Didn't know any path into it coming out of undergrad. And so I went and I would spend a couple years in the corporate world to try to get some just some experience. I was in corporate strategy first at Claire's, the girls' jewelry store, which is a really fun fact. I had a blast there. That was a tough time because they were all mall-based. And their model was basically give your daughter $25 while you go to JCPenney and you can hang out at Claire's. And that didn't work in the age of e-commerce and with mall traffic declining. So we were trying to iterate fast. After Claire's, I went to Walgreens on their e-commerce side, also on the strategy team. Really enjoyed that. I felt like I got my some basic building blocks of business experience, but I knew I wasn't going to be in the corporate world for very long. I had this, like I said, history of kind of generational entrepreneurship, as well as that passion to get into venture capital. So in 2015, I convinced my friends and family to give me $1 million to launch Fund 1. In hindsight, I should have called it Fund 0. It was like a beta fund, but Fund 1. And I quit Walgreens in May of 2015 and started investing full time into, companies in the Midwest. And I'm sure we'll get into that strategy.
Can you talk to me a little bit about this generational entrepreneurship? How far back does that go? Like, how rooted and seated was that in you as a kid growing up?
Yeah. So I say they were farmers, but you look at my family and they're all actually all over Indiana. They have started so many businesses, and they came over in the early 1900s, all these sons that had other sons, and there was lots and lots of Gutweins in Indiana. And many of them, they had a mill, they had a seed company, they had farms. My dad started a grain elevator business. And then, now there's a popcorn company. A lot of people know that because they have some advertisements. So that's just something I was completely surrounded by. And my dad was always pushing me to test out business, and kind of learn about how businesses operate. When I was starting my vending machine business in middle school, he was the one that said, well, you need to track what you're putting in these machines, what's popular. You need to track your margins and your cost of goods sold, and making sure that you're not giving away too much or too little for every 25 cents that, so he was and I'm like, okay, great. He also told me, don't eat all of your profits, which was, a temptation. I have a pretty strong sweet tooth, but, that was just some really basic concepts. He told me to, I go in to all these different stores around town, haircutters and banks, and I get 10 no's in a row. And I would just not want to go. I'm like, I don't want to go ask to put a machine in. And he'd be encouraging me, got to go ask again. We got to, that machine is not going to generate money in our garage. So you got to go out there again. So that was really some of the practices that were instilled in me.
How did you find this opportunity at the University of Chicago to be on the venture fund if you weren't familiar with VC before? I've heard about this model in a couple of places. I think we talked about it in Austin, Texas as well with a guest on the show. They had something similar. And it sounds like an incredible experience, but how did you even find that was something available to you?
That's kind of funny. It almost came to me. I thought at U Chicago, I was an econ major, and everybody's either doing consulting or banking. And there's all these clubs you can do that you can join. And I wasn't really that interested in any of them. And I was known as this person that had launched, we called it Scooterversity, the scooter startup. And I was known as that person that had launched that. And it had shown a lot of interest in entrepreneurship. And that kind of allowed me, like, I was literally asked, hey, we're going to get this started. Do you want to be part of the founding board of this? Do you want to be involved? I was like, yes, that sounds really cool. Working with other founders, backing other founders. Remember, backing is like a couple $1,000s, but these were idea stage companies, but it emulated, it was intentional. We had the advice of some VCs that emulated a venture fund, of how that they would operate and make decisions, have those partner meetings and do due diligence. So, that was how I kind of got into that.
What sticks out to you during that time as something you learned about investing that still holds true?
Well, I think one of the craziest things, and maybe given that context that I was surrounded by a bunch of people that said, this is how econ works, this is how banking and finance works. And then you go into venture capital and it's literally so subjective. You look at the meetings we would have and I'd be like, I think this is a great idea. I see the market opportunity here. You could extrapolate this out and that would be good. And you have my another student who I probably had a lot of respect for, completely arguing the other point and also having lots of data to back that up. So is it look more like a debate or like some subjective sides of the issue? There is facts, there is stuff you can point to, but the earlier stage you go, it's always the more subjective that is. And I think that was what was really interesting to me is, there's a lot you can point to and there's probably some that are on balance worse ideas and worse opportunities than others, but you can almost always make a case to back a company. You can always make a case to not back a company.
It feels like today there's this idea out there that to get into VC, one of the ways to get there is to go get some experience like you did. You said you joined a corporate at Claire's and at Walgreens to get some experience, but it feels like the common advice today is more go join a high growth startup and that will get you into VC. As you were thinking about your decision to go into a startup versus go into corporate to get experience, how do you reflect back on that? Would you have done it differently or do you like the way that you took it? And would you advise others to do the same?
Yeah, that's one of the problems with venture capital is it's not like there's that clear path to get into it because I was going to do consulting, it was exactly you do these case studies, you practice, and there's this season where you go and interview with a whole bunch of consulting firms that come to your campus. Like that's exactly how it's done. If I was going to do investment banking, it would be a similar process. If you want to do venture capital, there's literally no way to go. I wasn't as familiar back then with the concept of joining a startup as that being an option to get into venture capital. I didn't know that there was any route. I didn't know what my path would look like to get into that. I just knew it basically wasn't an option is what it felt like. And I pursued, I'm like, well, being on the strategy teams of these companies working in the kind of the consumer space, I mean, that was pretty interesting to me. So I pursued something that was interesting that was going to give me some broad skill set. And, I didn't think it was too option narrowing. Like I didn't think it was going to remove a lot of options from the table. But, I had also thought about going into consulting instead. I mean, I didn't actually consider working at a startup other than I did consider pushing full-time on Scooterversity and was kind of just, I just don't think we were that innovative. I don't think we had the skill set and the kind of the right model as what you saw about 5 years later with like Bird and Lime taking off. So I did not back my own first startup in a sense.
I want to talk about Fund 1/Fund 0. Somebody listening to this who says, I want to get into VC and I would love to start with my own small fund like this. Looking back, what advice would you give them if they wanted to start with their own Fund 0 about this size?
I mean, I have a decent number of people actually asking me this on a semi-regular basis because, they see that I started with a little bit and now we have, Fund 3. And I think one of the things is I actually lucked into a really good market timing with when I started M25. I had this hunch. I had been doing this research. I had been seeing what was out there, that the Midwest was going to be this big opportunity, that it was currently almost like an arbitrage situation, like almost like why aren't there more people, doing risky early stage investments? And I think there was some good, reasons why there wasn't. But that gave me a huge step up as somebody that basically had no venture experience and had a tiny fund without being able to say, well, I was at Groupon, or, well, I was a VC at this firm before, or like any sort of like, I have done this before. I had none of that. I've done nothing before, but I'm going to work hard and like invest in your company, try to help you out and just hustle and network and whatever. Like everybody can say that, right? Like, so that was what I was doing. That was my promise. And that actually, I was still able to find, to kind of move the ball forward with M25. I don't know if Victor, same Victor starting out now, was trying to do that. That would not be enough of an edge. You'd have to have something else at this point in time.
What changed?
The market's way more saturated in the Midwest and competitive, both from funds based here, but also funds from the Valley investing here. And in 2015, when we started, I think you could get into almost all opportunities just by being non-value negative capital. Now, at first, all I was value neutral capital, right? With the promise of trying to be a little helpful here. Now I would argue we're very value add, and even we still can't get into all of the best deals. It can be very competitive. And if you're just capital right now in the Midwest, which would be like me starting off right now, that's like not going to be enough to get into most of the highest quality deals.
Zoom into that and tell me what the value negative capital was like in the 2010s.
Oh my gosh. I have seen so many examples of bad behavior, but let's just say the average at the table was comfortable capital of firms that maybe stemmed from more of a private equity mindset and that were looking for, the complaint was they're looking for Series A metrics at seed prices. You hear that a lot. Or they're looking for safe outcomes. So companies that maybe they've only been growing 50% year over year, but now they're at 2-3 million ARR. They can buy in at 10 million pre, something like that. Looks like a very small stage growth equity, private equity. And also those firms tended to be run by people that had been successful in something and almost had been there, done that mindset where like their involvement was why you were going to be successful. That was kind of and I don't know if that was necessarily value negative. That might've been more value neutral capital. Value negative was like sharky family offices with like crazy non-market terms. Value negative capital would be investing as a small angel check and being very hard to work with, investing in a convertible note and then expecting to be able to call your note at the maturity date, trying to say, oh, I'll invest I've seen this, I'll invest $25,000 and then I need you to sign me for $5,000 a month as your part-time CFO, which is like, okay, or I'll invest, but I also need some advisory shares for all the value I'm going to add. And they end up getting like 5% advisory shares or something ridiculous. That's value negative. That's actively harming the business for lots of different reasons. And that still exists today. We push them out of the best deals. We make sure they're not like with us. But, it still does exist, but I think it's going away, hopefully.
It sounds like a lot of this change has come from institutional firms that have come into the region or are sprouted up from the region that are a little bit different and more sophisticated now. How have you seen angel and angel group activity change over that same period of time? Is that getting better or different? Are they coming from outside?
Well, I think those are, in some ways, I've seen, two different things with angels and angel groups. Angels have, because there's been exits, there's been people that have made money in tech. Whereas before, like even in 2015, we had some great exits, like Exact Target and Groupon and Grubhub and some things in the Midwest, but like there was very little people that were recycling angel capital. So most people that were rich angels had made their money on traditional businesses, agriculture, real estate, something like that. They're not gonna roll the dice on a tech startup, or if they do, they're gonna want it to be pretty far along, kind of like a growth equity mindset. Now we have some super angels across the region that have made money on a tech company exit, whether they invested or were part of it. And we are seeing more super angel activity. It's really helpful, writing 50, 100K checks or more. I love that. And there's not enough, there's nowhere near what happens on the coast still, but that can be really helpful for founders. And that's kind of can outcompete us sometimes. We're like, just move very quickly. It's, that's something that keeps us on our toes, which I think is, I'm a big proponent of more competition is healthy and makes us even better. The angel groups have almost been notorious for being really bad forever. There's some great examples of angel groups that actually work really well. They've almost federalized in a way, in a sense of like having a lot more central control and like can commit and like can whip their members into shape to actually invest quickly and significant amounts of money and do it all in one LLC and all these types of best practices. But a lot of the angel groups were like the country club and really investing in kind of having very high expectations, very onerous processes for the founders, sometimes charging them money to present or something really bad. And I don't know how much that's improved, other than I do know a few angel groups that have really pushed things for the better. But those are those start to look more like venture funds, at that point.
You've mentioned this concept of the best deals. I think you used that phrase a few times. Who determines what the best deals in the region are?
Well, Victor Gutwein and Micah Sim are, if they put their stamp of approval, that's the best. That's the best deal. Mike's my partner, for those listening. Mike is my partner. No, the best deals, obviously, as I talked about before, it's very subjective. We would argue a best deal is something just at a surface level, you can tell a best deal because there's a lot of money that wants in on it. It's oversubscribed. It has brand name capital trying to invest. These are what the market would say are the best deals. I'm not necessarily saying those are always what I think is the best deals, but those are what the market would say would be the best deals. Those basically founders that have a lot of choice in the capital they can bring on. And that's usually coming from a founder that has like a really well-known and well-regarded reputation within a community. A lot of times they have sold a business successfully or been part of a really rapid rise of a company. Sometimes it's for other reasons, like maybe the company is just, they're in the right market at the right time and they're growing really fast. Could be regardless of the founder's experience. Those companies, they get bid out fast for, they are oversubscribed. People want to invest in them. People want to back them, and they have their choice of the best capital. So at that point, that becomes like the best capital is trying to find the best founders and vice versa. And so we're trying to be the best capital in those situations.
Some of your original thesis was around this idea of an arbitrage opportunity. Mm-hmm. I'm going to make an assumption here that the best deals have less of an arbitrage opportunity because there's more capital chasing it. How much of your current view of the landscape is rooted in that let's find the best deals versus let's find the arbitrage opportunities?
Well, I think what has become is, so part of the original arbitrage was just like, these are undersubscribed rounds that are high quality, or they just don't have access. They don't have access to capital. Most of the capital that is out there in the world isn't willing to invest in Ohio or Iowa or St. Louis or wherever. And so that was the reason why somebody that's a no name could invest in great companies still. In M25 Fund 1, Now I think what we're seeing is we try to find our edge. Our arbitrage edge is an information and reputation edge, and sourcing opportunities often before most other funds, especially coastal funds, can even have access to it, and then being able to win with a huge footprint of founders, VCs, accelerators, service providers, podcasters that rave about us, hopefully. Jay always is talking trash, I know.
Well, I don't have a unicorn. I don't have a plush unicorn over my shoulder like Eric does.
That was my biggest mistake. I lost out on so many deals because I did not give Jay a plush unicorn.
Well, talk to me about Fund 1 and this $1 million that you have and how you decided how you're going to spend that initially. Like, how did you decide okay, this is going to be X number of checks versus Y number of checks.
Yeah. So this goes back. Another thing that you can still see in our current model that we thought from the very beginning harkens back a little bit to my U Chicago economics roots, which is we can't necessarily guarantee that we're going to be able to pick the best company. We're at the earliest innings of these companies. There's not a lot to evaluate relative to later stage companies. So I've always had this philosophy that we need to ensure we capture outliers in this power law dynamic that is early stage venture capital by investing in a lot of companies. Now, we have not taken it to the extreme. There are some firms that have hundreds and hundreds of companies per a portfolio, but we wanted to prove out that we could do more than is typical in a seed fund. So we need to kind of basically prove we can invest in 20 companies a year is what's kind of the initial model. So that you take that fund one, that's fund one we did, and we wanted to show a little bit of a follow-on strategy too. So we actually carved out like $700K, a little over $700K to do 21 deals. They said roughly 20, so we ended up doing 21. And that was like a $35,000 check, I think on average. We reserved the remaining for follow-on investments. That has tweaked a little bit fund after fund, but the core concept of doing a lot of the earliest stage is still very strong because we don't want to, even though we think we can pick good companies, we'll evaluate 150 companies and do one deal. We think we can pick good companies. We just don't want to rely on that alone. So we want to have a broad enough portfolio. And I've got, my roots, I did a whole bunch of Monte Carlo simulations, modeling out in Excel of all of the kind of likely outcomes and seeing how likely we are to return the fund, how likely we are to hit a 3x return, kind of all the different goals that a fund would have. And, ironically, you can be a mean return, but be top quartile or even top decile. And that's because the mean is actually way higher than the median fund. So most funds are way below the mean. And I'm like, well, if I could get the mean, we would be doing pretty good. That was kind of my mindset. So
if you're investing in more companies than the typical fund of your size, are you seeing that same multiple in like the number of companies you look at? Like basically, are you multiplying the number of companies you see to make that number of investments, or are you just investing in a higher proportion of the companies you see?
Yeah, I think at the beginning, it definitely was a higher proportion because we didn't have the deal flow built out. Now, I think doing a lot of deals has beget more access to deals and more deal flow. People come to me and say, "Oh, I'm sure you've already seen these deals." Oh, you see everything first. We have a reputation for seeing all the deals. I actually try to downplay that because I don't want people to assume that I've seen everything, because then then they won't share it, right? So it's just kind of a little bit of a catch-22. But we see between 150 to 200 deals a month. We do usually 1 to 2 deals a month. So it's about 1%. I think that's typical for venture capital. But we also don't have as narrow of a thesis. So it does allow us we can do a consumer DTC deal over here. We can do a B2B SaaS deal over here. We can do a fintech or insurtech investment. And that's all in the same portfolio. We're more generalist than some firms that are more focused. So that allows us to maybe pick up on more deals as well.
You mentioned before reputation is a competitive advantage. When you're saying no to 99% of people, obviously the people that I've talked to that are in the 1%, the 10 or so companies we've had on the podcast that have been funded by M25 have nothing but great things to say about you. How do you think about maintaining reputation on the nose?
We have everybody sign a non-disparagement. I'm sorry. I thought that would be hilariously poor way to try to keep your reputation. No, we think about this a lot because, the vast majority of interactions with people in the marketplace are saying no. And you can't just be like, well, we got to be nice. It's like, that's not enough. We actually internally, every year, we will go through our pass process of how we pass on deals. And passing, you're never going to come across great on a pass, but that like saying of like, well, I don't need to outrun the bear. I just need to outrun the person next to the bear. We're just trying to be better than everybody else in the industry when it comes to transparency and communication and treating a founder like a human. Like, the founder knows they're pitching, they're going to get told no to no. Let's just be one of the best interactions of the passes, right? Let's just be, hey, here's what we said. We're not going to, first of all, we try to outline on our website, even before you reach out on our website, as a pretty transparent website. We get feedback a lot. Then we say, hey, it's not going to be a fit for XYZ. Or we have that first call and we only escalate things. Like, we very intentionally are escalating things in our process, and not like, we don't want to spend time on deals we're not going to do. So when the founder doesn't want to spend time pitching VCs and aren't going to invest in the company. So we're trying to move forward the highest probability deals and then turn away as quickly and as politely as possible the vast majority of deals. So we practice sending pass emails, we practice reasons and why we're passing on companies. Obviously, if it gets really far along and we end up saying no, that's a more intricate process of like, hey, that's a conversation. We're spending a little bit more time with talking through why we're not going to move forward with an investment, because at that point we've taken a decent amount of time from the founder. So, we're trying to be really intentional. I think, and that intentionality is seen. Of course, some people don't like us, and I can only do so much, right? But we care. I think it comes across that we really care and we can empathize with you. We're not, on a different level.
What do you mean you practice sending pass emails?
Yeah, we run I think we like cheesily named it internally, like passing 101 or something like that, where we will have like, hey, here's what we're going to do. Here's some guidelines around pass emails. Here's what we say. Here's what we don't say. Here's, when to share what, when to offer what, when to do what. Now let's have some scenarios. Okay, you pass to me. Like, everybody goes and passes, one-on-one. Everybody goes one-on-one passes to Mike. Just, we're trying to keep that consistent of how we all want to, since from the top, Mike and I would want to treat founders. We want to make sure that all of our whole team is treating founders how we would want them to treat. And I think like that's just, especially we do that a lot of times if we onboard an intern or a temporary, part-time associate, then that's, we'll do that as well to make sure that message is consistent. Because like I said, it's actually like most of our time is probably spent on founders we've invested in, co-investors we're working with frequently, that type of stuff. But most of the quantity of interactions is this external large amount of people that are pitching and interacting with. So we really care about, how that's perceived and how we're interacting with those founders.
Now that you've been doing this for 6-ish years and more people are starting to take notice of the Midwest and starting to plant their flag and say, we invest in the Midwest because it's a great place to invest. What have you seen change over that time? Like, what are the trends that you're seeing now for opportunities in the Midwest or the types of companies that are coming here? And especially if you can draw some contrast between what the tropes are, what some of the assumptions are now versus what you're seeing. So
when we started, there was this dearth of capital. We talked about that quite a bit. This was changing already pre-COVID, and then COVID really kicked it into high gear. But the access to capital, being a founder in the Midwest, I think is going, it's not maybe 100% to zero, but it's going. It's like that trend line is like that asymptote is kind of like we're going to where that's not going to be an issue. Part of it is because of people like us that are highly connected early stage investors that then can sync those investments into Series A capital on the coast or something, or bring together a syndicate of nationwide investors. Because it is still very much warm intros, but your hesitancy to invest in a company in Indianapolis or Chicago or Minneapolis is way less than it used to be as an investor based in the US. That's changing rapidly. I think that's kind of obvious. The other thing is the access to talent has drastically shifted. Part of it is there's companies that are headquartered here. They probably have an office here. And okay, half of their customer success team is overseas. They have engineers wherever they could find them throughout the US, North America, international. And the remote willingness to have a remote team has shifted, but also just the ability and the and employees looking for work aren't looking for work in their town. Sometimes they're looking for work with people that have a cultural and goal and vision minded fit. And so that's great. But even if you wanted to look for talent in the Midwest, that's now here. Like, we have so many people that are spinning out of companies and getting hired from other, tech company after you look at somebody that spent their whole life in Ann Arbor now, and they may have gone from Duo to Census to Blumira. Like, that's their whole, and they have 10 years, 15 years, and that's a very experienced person. They didn't have to go all the way over to Facebook or Cisco and or somewhere in SF and then come back. So you can actually find homegrown talent that's 10 years, 15 years, 20 years developed with basically homegrown tech, software, digital companies. That's pretty interesting too. It's less common, but you can build especially your first parts of your company with that talent. So I think access to capital and access to talent have shifted drastically. That's something that used to be the biggest reasons not to invest here, and why companies couldn't be billion-dollar companies here. And that's just, that's basically completely almost going to zero.
So if those problems are gone away, what are now the new problems that you're seeing trend lines in for companies in this region?
I still think there's a cultural gap of where people are settling for smaller exits than would be acceptable on the coast. And it's part of it, and my partner Mike actually talks about this a lot, but the culture of allowing somebody to fail or not is still pretty, like, people that are at the point where they could sell for 20, 30, 40, 50 million, they're going to feel like they should take that versus risk rolling the dice, taking on that big Series A or B round and going for something that has to be $500 billion, $2 billion exit. And a part of it, we have a lot of first-time founders. We have a lot of people that haven't gotten rich yet on tech, so they're not as willing to go big or go home. But also, I think it's this more conservative culture. And you can be super local famous for selling a company for $20 million now in Detroit or in St. Louis. You're going to make the headlines of your local business journal. Everybody's going to ask you to speak for the rest of your life. You could be an EIR at your local university. You can angel invest. It's a good life, but you didn't change the world. You changed your cities, a little bit, but not permanently. Changing your city now, you need to have Root Insurance IPO in Columbus. You need to have Cover My Meds. You need to have Duo Security. Like, those are permanently changing the tech landscape and really the local economies of those cities. So that's what we're trying to push for. We want more of those to happen.
Do you think there's room for a different source of capital to fund those more conservative-minded exits?
Well, definitely. I mean, there's already been an explosion of SaaS-based lending. The rates you can get on that have gone down in the past 5 years so tremendously. Like, it used to be 35%. Now it's like 15 to 20%. It's a lot easier, a lot more commoditized. And those people aren't even pretending. Like, they're just like, yeah, we're capital. Maybe we'll have some value add, but really, like, our value add is like easy, flexible capital, very founder friendly. You can keep control of your company. Like, it's exact. And they can pair up with venture too. I don't think those are mutually exclusive. It is hard to find capital that would back before you can get to that strong enough of a recurring revenue base for companies that aren't looking for huge outcomes. That's always been the case. And I don't think that's ever necessarily going to be, I think there's a reason for that, is like, if there's not a chance at a huge reward, it's really hard to risk something that's pre-revenue or very early revenue on an early founder that's specifically looking for a lifestyle business, basically, or a smaller exit. But I know there are firms that, like NDVC was, doing that and stuff. It just hasn't been where the vast majority of capital is interested in being deployed. And there's probably, efficient market theory here would probably say there's a reason for that. But
look at you being a U Chicago guy, pulling out efficient market hypothesis.
Which is funny, because my whole premise of M25 initially was it's actually a little inefficient. But I said that because there's some significant transactions costs of doing deals here at the earliest stages. So, I mean, it's inefficient, but I can have an edge that would make sense for me because I'm here.
You talked a little bit about how capital is traveling better from the coasts. It's coming in. It's going into the best deals. When you think about M25's thesis going forward into the fund 4, 5, 6, 7, can you stay geographically focused, or do you need to expand beyond the Midwest?
Talk about this a lot. Like internally, we're always wondering even during COVID, we had questions like, what does geography mean? And we have founders that are like, well, I'm currently at my parents in Columbus, but I live in New York, kind of, not now, not for the last 6 months, and we just have these issues and we're like, well, where's the company based? Like, what does it mean? And we've been among the most strict when it comes to our definition of geography because we think that's a huge advantage. We think that, yes, I could invest in a great company in Denver. Yes, I could invest in a great company in Nashville or Toronto. But where am I always going to have the best visibility to? I'm always going to in the markets that I've already done 4 or 5 deals in, that I know all the founders. I know all of the opportunities I'm visiting regularly, physically. That has been a core part of our thesis. And also just, we win deals because of, we're not just some fly in, fly out. We're literally, we've committed to invest for the past 6 years in Cincinnati and in Cleveland and Pittsburgh. So expanding that would be very intentional if we did. Right now, we haven't felt a need because we are sourcing so many great opportunities here. If we felt like we couldn't deploy the capital into amazing world-class opportunities, or that we were somehow losing or just like our edge wasn't as valuable and we had a different edge that was more transportable. But I can see us, I can definitely consider in the future, especially with markets that have some similarities. They're not very, very over competitive, and our story can resonate. We can maybe have some pre-existing relationships. I can see that for sure. I just, right now it's been so helpful to be so focused. It's been a huge comparative advantage for us.
So if we assume that you stay focused and keep that advantage, do you see yourself ever moving upstream to leverage that same advantage in those same geographies with a higher chance of winning bigger, more growth focused rounds?
Yeah, I mean, right now we are known. We say we really won't even do a deal over 10 million post, which is actually kind of hard sometimes, in how crazy recently the environment has been. It's just pushed us sometimes to go even earlier, but that's been a guideline because we also basically the same thing with geography. We get invited to plenty of Series A rounds, Series B rounds. Those are not the best Series A and B rounds. I know that because then 6 months later, those, sometimes I see 6 months, 12 months later, that company's under, We want to be always investing in the best in class of a certain, whatever our slice is. I think there's definitely an opportunity. Maybe first you lean into the companies you already know. You just deploy more money. Right now, our fund size hasn't demanded that. It hasn't required us to, in order to deploy our whole fund, we need to do later stages. I do think that the highest IRR and highest opportunity is in the earliest stages, and that we found a successful way to mitigate the risk of the early stages with a highly diversified portfolio. So that has been our focus, but I'm sure, that we'll have deploy further down the line if we stay in this geography and have bigger funds. Then that's basically gonna have to happen.
Sitting here in Columbus, we talked about this a little bit before we got on the mics. From where I'm sitting, I feel like I don't see as many early stage startups starting here in Columbus as I used to, or it seemed like there was like a wave of them, and I haven't seen a new wave of them. And I may be out of touch, and you can tell me, no, that's actually happening in Columbus. We see it all the time. But if I'm not out of touch, are you seeing something similar around the region, or is there a pretty good wellspring of new fundable companies?
I don't know how much we can say that it's like a trend, or just like do we have enough of an in this data set to really say that that's causal of something, or just, the randomness? Because I haven't done a deal in Columbus in over 2 years, but we did 3 deals in Ann Arbor last year. So I think part of it is like sometimes there's waves. I think within 15 months, I did my first 5 deals in Cincinnati from 2017. And then I didn't do another deal in Cincinnati until 2019. And, it just kind of, so on a city by city basis, it's hard I think to look too closely at that. Across the region though, we are not seeing like that entrepreneurship or founding of companies has gone down. I think it like slowed down in 2020 from the raising standpoint, but I think a lot of people, all these companies I'm talking to now, in March, I decided to start my company. Like, it was right in the pandemic, or I was working on it, and then I went full time. Wasn't maybe I got let go, but maybe I just decided this is the opportunity to work on something, and now they're raising. So we're seeing plenty of deals raised right now, and I haven't seen many in Columbus specifically, Jay, but I mean it does kind of just go through different cycles. At one point, Columbus was the hottest market for us, and that was like 2018 or something, and we were seeing so many opportunities there.
And maybe it's a function of, you said like there is now homegrown or local talent in these areas, but that doesn't necessarily mean that talent is comfortable taking the risk of starting a company yet. Like maybe that talent is accumulating in some of these companies that did spring up 2 years ago that's now trying to hire all the best people, and they're tied up, and that's why it feels cyclical. We talk about the metaphorical flywheel on this show a lot. And we haven't like really seen a definitive example of it playing out, but like, is it too early to see an ecosystem flywheel? I don't know.
And in other ecosystems, I see it much more explicitly. Ann Arbor, I just mentioned, was the Duo exit. Lots of talent starting lots of different companies, not just in cybersecurity, but many of them in cybersecurity from the Duo exit. Exact Target was several years before, but that was one that spun up. It technically has a lot of children because of the High Alpha Studio, which has specifically just created lots of startups, but also other people that weren't High Alpha related, like PackSafe, had a lot of the talent coming from Exact Target. And so that's, it's very explicit in other ecosystems. I've seen a few companies obviously come from Cover My Meds, a few years before, like Root IPO'd, and that talent has gone on to create companies like ScriptDrop and I think Ready Health. And so, there's a few, coming out, but I haven't seen it quite as frequent or as dramatic maybe in other ecosystems yet.
How many early stage venture capital firms do you think the Midwest could support today?
Yeah, I mean, sometimes it depends where you draw the line at early stage. Like, would you call Drive Capital early stage? Because to me, they're later often, but in the scheme of things, they are probably considered, they do a lot of Series A. It's kind of maybe their bread and butter, but that's, I think, the only $1 billion AUM fund in the Midwest, and by a wide margin. So if you look at a lot of the funds around the Midwest, they're going to have an issue in the sense that as it gets more competitive with coastal dollars, none of them can compete on dollars on like leading around or valuations or capital deployed, because they're all $100 million funds or smaller, basically. And so I think a lot more money could go into these funds. Or, part of it is I've always had a thesis that, especially as we go back into more of a physical age, it does really pay to be locally located and when sourcing the earliest stage of investment. And it's hard to be local when your ecosystem is just Columbus or even just Ohio. It's not producing quite enough deals, although there are funds that are specifically focused on Ohio, but a lot of times they'll go then to do a little more later stage, or maybe a little even broader. They'll do life sciences and digital. But I think that there's plenty of opportunities. I think it's about 10% of U.S. venture deals are here. You could easily have more funds or more dollars in the existing funds here, and it would still be, there'd be plenty of investment to go around. I think right now, because that's not the case, we are seeing lots of our deals, even sometimes at pre-seed and seed rounds, getting money from coastal firms. Even like not even top, maybe not top name coastal firms, but just coastal firms that see the opportunity and realize, hey, I can write $1 million, whereas the fund in Chicago can only write $500K. So I can get my ownership and offer twice the price. Basically, I'm gonna win. Like that's the mindset. once again, I do think the market will correct that, or there'll be other opportunities, and we're just going to have more coastal money sweeping in, and maybe they'll set up offices here, like Mucker did, kind of as you just did the interview. So we're seeing that too. Coastal VCs spending more time, some of which are relocating permanently here.
So one of the unique things about M25 is this summit that you put on. I think it hits back to those two competitive advantages you talked about as well, with information and reputation. Can you kind of talk about what that is, how that came about, and maybe the idea behind it and what it's become?
Yeah. So this started by just seeing that we have a lot of founders, but they're all spread out. And we have the disadvantage in the Midwest is that the ecosystem is across a wide geographic area. They're not as connected to each other. So we thought, how do we start to bridge some of that gap? We invited all of our founders up to Chicago for the first summit, I think in 2017. And it was literally, we had some beers, maybe a panel, and just some social time. And it was probably 30 founders at the time. And we saw a lot of really magical things happen out of that, relationships, people helping each other out and learning from each other. So then we started to build that out. And one thing that happened was we started to invite VCs to specific parts of the summit. And that has grown to where now the last summit we did in person was right before the pandemic hit. And our next one will be in September. So we're excited to bring it back. So the last one we did in person was over 200 VCs, and from all over the U.S. and Canada. It was all over North America. Some of the top firms, Excel, NEA, Bessemer, a lot of those firms have come, as well as a lot of the regional firms that are trying to source more deals here too. And then I think we had 60 or 70 founders of ours across the portfolio come. We had over 500 one-on-one matches that were double opt-in, so VC to founder that met. We've had Series Bs raised from meetings here. We've had even seed rounds. So maybe we did the pre-seed, they did the seed. We've had a lot of capital driven into our companies, and it's very intentional matchmaking. People both have to select and do it. And then we've had some great outcomes from just the founder relationships happen. We do a whole day basically. It's just socialization, founder roundtables, some founders speaking about certain things, how to hire, after raising your Series A, how to hire a bunch of people, after maybe the best way to increase your SEO and selling a consumer product, right? Just to the consumer founders or something like that. That's what we would put together. And that has caused a lot to happen. Now it's become the biggest event in the Midwest for VCs. And it's something that we've actually even had founders take our capital just because they want to be able to attend this event, because it's only for our founders. And that's something that we just get excited about, ways to continue to expand that and make that more powerful.
Well, Victor, this is great to finally have you on the show. You've been one of our biggest advocates, so I can only imagine how much you advocate for people that have your money on their balance sheet. So thank you. If people want to learn more about you and M25 after the show, where should they go?
Definitely check out m25vc.com. We're on Twitter, on LinkedIn. You can also email victor@m25vc.com. And we usually are pretty good at getting responses back. So try to value your time as much as we value ours.
Eric, do you know what I love to have for breakfast?
A big old bowl of J.O.'s. I just imagine you have a box of cereal with your face on it.
I was going to say reviews on Apple Podcasts. They give me more sustenance than anything else in my life. They bring me energy. They get me ready for the day ahead. And Eric, it's been a minute since I had a good bowl of reviews on Apple Podcasts.
Sometimes I read my reviews right before I go to bed, just so I can dream good dreams at night.
If you want to help me start the day right and help my self-esteem while also helping us in the eyes of Apple, please leave a review for Upside on Apple Podcasts. If you have an iPhone, even if you don't use Apple Podcasts, we would love for you to submit a review about why you love Upside. And if you don't have an iPhone, if you're an Android user, that's okay too.
All right, Jay, we just spoke with Victor Gutwein of M25. Little Easter egg here for the listeners, a little behind the scenes. I don't think I use Easter egg appropriately for what I'm about to say. We have been contemplating when to have Victor on the podcast for probably about 3 years now.
And he just kept telling us no, you wouldn't do it.
That's what it was. Yes. He told us no. It was not us saying no to him. No, we wanted to have a very special episode where Victor came on, where we were celebrating something. 3 years is a huge landmark in the podcasting space. Most podcasts, actually like 96% of podcasts, never make it to 200 episodes, never make it to 150 episodes, which is usually the 3-year mark. And we wanted to have him on for something that was, an arbitrary number of episodes, of course, and an arbitrary number of years, but something that were meaningful. So I'm happy we had him on. I'm happy we had this conversation.
I think M25 really came onto my radar first in episode 4 or around episode 4 when we released our script drop episode with Nick Potts. And he talked about how, despite being an earlier VC and a smaller fund, the team at M25 really went above and beyond and worked their butts off for him. And then we heard similar sentiment from Seth Miller at Rap Chat.
I feel like I hear that sentiment all the time, even with companies that we don't talk to on the podcast. The M25's ability to engender itself to founders is going to be a long-term competitive advantage. They're building a brand of advocates at scale.
It's really easy to say you're a value-add investor. It's really hard to build a genuine reputation as being a value-add investor with a portfolio of companies. And I don't think there's a firm doing a better job than M25.
I was interested to hear that while they contemplate the future in terms of scaling beyond the Midwest geography and scaling upstream in the venture world, which would be going to kind of your Series A, B, Cs, there's no real firm plans to do that. It didn't sound like. There's ideas and constructs and concepts, but I would have thought, and this is me, that there was more of a master plan.
I don't know. I think that, M25 innovated on how they were deploying capital in the beginning, and that has put them in a unique position to either continue to do that in the same way or to continue to innovate and do things differently. And maybe they just haven't made that decision in total yet.
It feels like they're currently investing in increasing their optionality and simultaneously increasing the strength of their reputation.
We did say in the intro that M25 historically has taken a very strong stance on what the Midwest is. But as we saw in 2020, what does it mean to be headquartered somewhere when you have a distributed and remote team? What does it mean to be in the Midwest versus not for those types of companies that are building teams differently and working differently?
All fun questions that maybe we should have a remote-focused VC on here to counteract the idea of geography first.
I'm sitting here looking at M25's portfolio. How many companies do you think M25 has invested in since 2015?
I'll go with 90.
107
was
listed on the page.
That's pretty close.
That is a lot of companies. If you're investing in 107 companies, and that is a small percentage of the pitches that you see, we're talking about a lot of pitch meetings.
He said, 100 to 200 or something like that every month, and they only do about one investment a month. So that's a lot of no's, but it's also, they see a lot. It's very hard for me to make introductions to Victor, although I try to, and we do, because I think I send him a lot of stuff, and he's like, oh yeah, that's great. We saw it. We're excited about it. Or, yep, we saw it. Or when I talk to founders, they've already sent something to them. So the brand, the investment in reputation and brand, I think is paying off, and it's going to be a compounder for M25. 10 years from now, that brand, I think, is going to be so much incredibly stronger than it already is.
That's the model, making an edge on sourcing information, having a huge footprint. We see some VCs that build scout networks, but when you invest in so many founders and have such a great reputation, those founders will probably essentially act as scouts on your behalf for free. So why not do that?
I love it. I love what M25 is building. If you have any thoughts on M25, their model, or anything you heard in this interview, reach out to us at Upside FM on Twitter or hello@upside.fm if you have something a little longer via email. And we will talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear what you think about this episode, so tweet at us at UpsideFM or email us hello@upside.fm and let us know. You can learn more about us and browse our entire back catalog of episodes at upside.fm. And if you love our show, please leave a review on Apple Podcasts. That goes a long way in helping us bring high-quality guests to the show.
Rocky and Sylvester. One for underrated, two for underpaid. Today I'm gonna get it, and there's nothing in my way.